morning, everyone. I have with me Deputy Governor Jeff Baskand and Assistant Governor John McDermott. And the Reserve Bank today left the OCR on hold at 1.75%. In our forecast, the global economic recovery continues to improve and broaden. Inflation remains subdued, although there are some signs of emerging pressures, as we saw in the US labour market data late last week. Monetary policy remains easy in the advanced economies, but is gradually firming. GDP growth eased in the second half of 2017, but is expected to strengthen going forward, driven by low interest rates, increased government spending, the high terms of trade and population growth. The labour market data yesterday showed unemployment down slightly to 4.5%. We see the labour market continuing to tighten somewhat through the forecast period. Regarding the impact of government policies, the bank has revised its estimates based on Treasury's half-yearly fiscal update, and this has resulted in the near-term impact of these policies being revised down somewhat. CPI inflation in December was lower than expected at 1.6% due to the ongoing weakness in manufactured goods prices. Traded goods inflation is projected to remain subdued through the forecast period, while non-tradable inflation is expected to increase with capacity pressures. Overall, this results in CPI inflation trending upwards towards the midpoint of our target range. Monetary policy is likely to remain accommodative for a considerable period. And I might just add that while these forecasts were closed off ahead of the recent equity market volatility, at this point we would see no reason to alter the forecasts. So thanks very much, and we're welcome to answer questions. Well, we're within the band. December number was 1.6. Our target range is 1 to 3%. And yes, we try to target the midpoint of the range over the medium term. But this is what we call flexible inflation targeting. We're never trying to achieve continuous 2%. And if global and other pressures are pushing us away from the midpoint, then we take quite a patient approach to getting back to target. And, our numbers show we are coming back to target. You're right, it's taking a bit longer than we had previously thought. The surprises have tended to be on the downside. But, the topic we're just talking about with international inflation pressures, at some point in the future we may have surprises on the upside. So we're confident that we're headed towards the target and that the policy stance is a sensible one.
Well, perhaps just to emphasise that the target specified in the policy targets agreement is 1 to 3%. With a focus of 2. So the best way you can stay within the range of 1 to 3% is when you look forward into the future, about 2 to 3 years across the business cycle, you keep your eye on 2%. The 2% itself isn't, as I understand how the words are written, isn't the target itself.
Well, in terms of the labour market, there's a lot of moving parts, but overall, we think a neutral rate of unemployment, we think it's in the range of 4 to 5.5%. The point estimate that we mentioned in the document of 4.7. And, the most recent number we just came out yesterday was 4.5. So we think we're reasonably close to a sort of a neutral level of unemployment. Yeah, the housing market has moderated, and various things contributed to that, including policies from the new government, as well as the LVR policies that we had in place. And so the mood of the market has moderated, came off, particularly last year. But monthly price increases did pick up a bit from about August. And we have a situation where the rest of the country is still quite a bit stronger than Auckland. We still have a situation where population growth is probably exceeding the growth of new construction. But on the other hand, in the investor segment has lost its appetite, you might say, for investor housing. So the share of investor housing is substantially reduced in sales and in credit. So we think those factors will keep the housing market moderate over the coming year or two. But, we do say in here that that is a risk. The risk is with construction being relatively soft, being constrained by capacity, etc., population still growing, that upside on housing is still at risk. It's more upside than downside. There's all sorts of hypothetical scenarios, but at the end of the day, interest rates are a lot more powerful tool than macroprudential. Macroprudential's primary purpose is the safety of the financial system. And, we can't fine-tune the housing market using macroprudential. Interest rates have much more pervasive effect and a stronger tool generally.
There are quite a lot of uncertainties about the housing market that we touch on in the document, including just how severe the capacity constraints are. So part of the risks are sort of, and again, a bit two-way, that the difficulty of actually getting enough building done does pose a bit of price risk, does pose a bit of downside on the growth track if those capacity constraints bite and prevent the pickup that we're expecting to see. So I think we're watching the housing market very closely would be the best description of that.
Well, I think the flexible inflation targeting has been a good framework. I think we've certainly learned that. I think I would also say that be very careful before making moves, that patience is a virtue when it comes to monetary policy.